You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Thank you, Wedbush Securities. Scot Warren is Executive Vice President of Business and Product Development at the Options Industry Council at OCC. He will moderate our panel this morning. Scot is responsible for overseeing OCC's business and new product development, as well as strategic and corporate planning. Before joining OCC, he served as Senior Managing Director, Equity Products and Index Services at the CME Group. Scot, take it away.
Well, thank you very much, and welcome to the Friday the 13th edition of the Exchange Leaders Panel. We hope that's not going to be an ominous sign for today's discussion. I'm very fortunate to be joined today by leaders of each of the exchanges. With me is Ed Boyle, CEO of BOX, Kapil Rathi, Vice President of BATS Options Global Markets. Next to him is Kevin Kennedy, Vice President and Head of U.S. Options for Nasdaq. Then next to Kevin is Ivan Brown, Head of Options for NYSE Group. Next to Ivan is Shelly Brown, Executive Vice President, Strategic Planning Operations of MIAX Options. And last but certainly not least is Andrew Lowenthal, Senior Vice President, Business Development of Chicago Board Option Exchange. Over the course of the last 2 days through the sessions and then committee meetings, we've gotten to hear a lot of the feedback on regulatory pressures the industry is facing. And as I step back and think about the 40-plus year history of the U.S. options industry, you can look at the first 20 years as largely building infrastructure and expanding an ecosystem. The next 20 years were really about volume growth and expanding capacity. The more recent history that we've faced, we've found that in post-2007, growth has come, and the growth for the industry is a lot more challenging. And so as we step back today, I think it's going to be an interesting time for the exchange leaders to share with you their thoughts on the headwinds the industry is facing, and then the perspective of their exchanges and what can be done about it. So with that, we'll start with Ed. If you can give your perspective on the largest challenges the industry is facing.
I think that the challenges we're up against today are really, they're twofold in a lot of ways. One, the product it's still, while we try to do a very good job of educating and getting the product out there and getting options out there, it was such a great growth product through the 2000s, and as we went into really the fully electronic market, so what helped it. The end users are not as educated as they could be. The retail, the online brokers seem to have done a very good job of getting all of their participants educated in a lot of ways, but there's still a lot to be done there. Where we really, I think, should be able to make some headwinds is with more along the lines of institutional business, advisor business, that kind of hedge fund areas. There's a lot of very large institutions that don't trade any options at all, and they don't understand the risk strategies they can use. And the other problem they've got is that cost of access for them can be much higher than it is for the client, for the retail customer. And the notional value they're not always able to get it. So we hear the complaint constantly that we've got, there's the markets on the screen have widened, the liquidity's not there. These guys can get large notional value, but they get it upstairs, and when they start going upstairs, they turn them into OTC trades quite often. It's much easier to structure a note and do it as a bilateral trade. And while there is a large effort over the last couple of years after the financial crisis to bring that to the displayed market, or rather to the cleared market, centrally cleared markets, much of that business is still done in the OTC market. And I think that's where we need to find not only products, but a market structure that works well for them. Then we also hear, of course, I won't try to address everything. I'll give my colleagues a chance to chime in on this, but the widening of the markets that we've seen, and there's certainly some truth to that. We can talk about it a little bit later, but the finding ways to make our markets more structurally solid and safe for the participants, while at the same time getting the quotes on the screen, which is the advertising, much tighter. Everybody in this room knows that if a customer comes into the marketplace to trade, he's going to trade much closer to midpoint. The problem is that advertised price is too wide, and quite often they don't even want to trade at all. So I think those are a couple of the significant areas we need to improve upon in order to move forward.
Well, thank you for that. And on behalf of OCC and its education arm, OIC, the industry's education arm, we share your commitment to the focus on education. The Harris poll that OIC had conducted clearly represents that retail investors aren't going to trade a product that they can't understand, and continuing to focus on retail education and expand into institutional education, I think, can be a real catalyst for growth. Kapil, what's your perspective on the challenges, or the largest challenges you think we're facing?
I agree with pretty much most of the things that Ed has said. In the last couple of days, we have heard a pretty good sort of laundry list of challenges that industry is facing, whether it's the auctions, quality of the market, fragmentations. I think I won't necessarily go into each of those, but the key is how we collectively as a group can overcome some of these challenges. You can solve a problem by innovating, or you can solve a problem by collaborating. So I'm still a big fan of us working together on some of these issues. Yesterday we heard SIFMA Chairman Joe Salido talking about how harmonization is very difficult in this market, but we have achieved quite a lot by harmonizing some of the rules. Obvious error, one example. We should pat ourselves on the back. So we have done really incredible job by working together. They're very smart people on the exchanges sector. We can definitely overcome some of these challenges that industry is posing right now. So without rehashing some of those specifics that we have already heard, I do want to talk about some sort of fee-related observations that we're seeing in the industry, especially what we are hearing from our customers. There are two different fees that are currently sort of are on the upside with the competition and fragmentation. The fees conceptually should go down. The cost to trade, the transaction fees are going down. The fixed costs are going down. But we are hearing the regulatory costs are going up. And up to some extent, we're also hearing clearing fees are going up. On the front of regulatory cost, not sure how many of you are aware of this concept of option regulatory fee, where each exchange is able to charge every customer contract no matter where it trades. As you see these new exchanges coming up, every exchange is pretty much piling up on the same contract. So yes, these fees are very small as individually on our fee schedule, but together they pile up. We're hearing a lot of complaint from our retail brokers that at some point we need to stop piling up on these type of fees. There are some small exchanges who probably are charging more than what some of the bigger exchanges. You can argue that are they really regulatory fees, or they are actually funding their cost of operation to survive. So I think we need to be very careful about what type of fees we are bringing. The second fee issue is clearing fees. We are, I think, in the last couple of years, they have grown 25 to 30%. And last year on this panel, we talked about the OCC capital plan. I know that ship has sailed. OCC has done an incredible job. I think I give a lot of compliment to the OCC management, what they have done in the industry. But I think we're heading towards a slippery slope of having 3 exchanges owning the OCC right now. It's funny, there were a lot of chatter around in the last 2 days. I heard about Nasdaq ISE merger. People are asking, why is Nasdaq paying $1.1 billion for ISE? And the answer I'm hearing is it's less about the market share, it's more about OCC stake. When did OCC turn into an investment vehicle? Why are we treating OCC as a sort of profitable venue? It's supposed to be a non-profit, single-purpose organization serving the industry, and here you have 3 exchanges taking advantage of the fees going up, getting, $19 million dividend? These are the things that we have to very carefully watch out. We can't just keep taxing the industry for the benefit of 1 or 2 exchanges here.
Well, thank you for the perspective. We'll have some opportunity to discuss that a little bit later.
Way to get it out there.
I thought he was going to ask about dividend trades.
Yeah, gosh, this is turning out to be more fun than I had hoped.
We have
Mr.
time.
Kennedy, can you give us our perspective? Because we will come back and have an opportunity.
I shared a jog with Kapil yesterday. Not once did we talk about any of this, which is really good because we're not supposed to. So headwinds. Eddie said it. Kapil has said it. Everyone here has said it. I mean, it's to the point where we all sitting in this room know what this conversation is going to be about. It's going to be about auctions, liquidity, regulatory headwinds, and it's all true. So I think that we need to address, for every segment of our participant, whether they're an IDB or a big bank or a small market maker, there are regulatory headwinds, and everybody has their own little pocket of what they're interested in. So I think we need to work as exchange operators with our clients and work to fix that. And we do that where anybody comes to us and says, we have an issue. We have an issue with the way FINRA is going to regulate us. We have an issue with the way your quoting obligation rule is. And we're here, and I think we should all do that. I think we all do that. So I think we need to make sure that other forces are not impacting our liquidity, because we're going to talk a lot about liquidity today. And I think it all adds up. There's not one, auctions aren't the problem. Auctions are part of a problem. I think that so the big headwind, I would say, is regulatory. I will say a little bit about ORF in that I think Kapil does bring up some good points. And I think that there should be much transparency around ORF, what's going into that fee. I can tell you that there is pressure to keep it low at Nasdaq, and it's one of the benefits that I think you'll see with our proposed pending regulatory approval merger is that, as we reduce expenses, and Nasdaq's pretty good at reducing expenses, we should see a benefit to the industry. Might not help any individual group here specifically, besides retail, but it will help the industry. So I'm excited about that. Other than that, I think that a lot was covered by Eddie and Kapil, and we can just probably get on the path before we take everything away from the rest of these folks.
Ivan?
Yeah, I think generally we're advocates of market structure that promotes displayed liquidity and transparency and price discovery, and so headwinds that are in direct opposition to those goals are of chief concern to us. So really, when you look at it and you say, okay, industry volumes over the last couple of years have largely plateaued. Equity and ETF option volume year over year is down slightly, roughly 3%. That universe is becoming somewhat finite. In addition, the fact that finite universe is becoming more fragmented, is of concern as well. The rapid proliferation of exchanges. Normally, competition is healthy to the extent that it encourages innovation and new ideas and brings utility to participants in the marketplace. The question becomes, though, is that, are we getting to a point where, the marginal benefit and the marginal cost are intersecting? Another thing that we think about, too, is just, and this is something that's been echoed on a number of the panels, is concerns around volume migrating from traditional, more preference-based exchanges, which require lit quotes on the screen, into an area where you can be more selective about stepping up and providing liquidity in auction mechanisms and such. And so, echo a lot of the sentiments of my colleagues up here in terms of where they're seeing headwinds as well. So,
Shelly?
Agree with a lot of what my colleagues have said. Added to that, the regulatory burden on the exchanges and the members, especially coming through Reg SCI. We're seeing pressure from the SEC in as much as diversifying our location of our data centers. These sorts of things are going to put a lot more cost pressure on the members, causes the market makers have to co-locate in multiple places. Reg SCI in general, it seems like it's a strong reaction to a perceived problem that doesn't really exist. And the reality is we all back each other up, other than the handful of proprietary products. If our exchange is down or another exchange is down, all those products are trading on other exchanges. And it seems like it's adding a lot of unnecessary cost. The other thing that's frustrating, I'm sure all of you face this, is we want to innovate. We want to do new things. We want to try different things. But it's very hard to get some of these ideas through the SEC. We work very hard to try to educate them, understand what we're doing as an exchange, what the technological differences are, what the rules really mean. That's been a constant battle. We'd also like to see FINRA and the SEC provide more forward guidance. There are so many issues facing the industry where we have diverse opinions amongst, whether it be the market makers or the order routers. And having guidance of how things should be done, how they are going to regulate us going forward, would be very helpful to the industry, because we've seen too many situations where we've thought we were doing the right thing, and then with 20/20 hindsight, we've seen FINRA or the SEC come back against firms for doing things that was a generally accepted practice we thought was the right thing. So more guidance would be very helpful to all of us.
Thank you, Shelly. And Andrew?
Thank you. I think they got everything, so I'm done.
Okay.
So when I was thinking about this question, I thought about it a little bit. I tried to go a little bit above the trees. I know one of the issues that I've had many conversations on at this conference is the impact of Basel III, risk-weighted assets, the current exposure method, the imminent SACR measurement for banks as the way that they have to measure, the way their capital is measured. These are big issues, not only weighing on the banks, but weighing on our market-making community, and something that I think all of us as an industry have to clearly front and center for all of us. Another issue that's out there, although currently I would say not necessarily imminent, but it comes up very often, are taxes in our business, both a financial transaction tax and potential change to the 60/40 rules are things that we have to keep our eye on. I know in the last Obama budget, there was the introduction of the 60/40 rule. Of course, the camp rule has been in our market now for the last 3 years, or at least the concerns around it. At this point, again, we don't see anything imminent coming down the pipeline, but it's something our industry has to keep an eye on, and clearly could create some headwinds. The market issues that have been discussed throughout this conference, both at the debate yesterday and Henry Schwartz's overview on day one, I thought both of them did a great job of fleshing out many of those issues. I think all of us up here are taking those into consideration every day in the way we run our businesses. Another issue that we face at all the exchanges is what we see basically exchange look-alike type trading, products that could come to this exchange, in many cases are even priced on the exchanges, going to the OTC markets. That's a concern for us. We have a comment letter on file with the SEC where we would like to see the SEC take a serious look at that issue. The market makers are providing liquidity, and then you see that order go away from the exchanges and print upstairs to get around some regulatory issue. We see that as a major concern. And lastly, the DOL fiduciary responsibility. Yes, we escaped the biggest concern. Our product are still going to be allowed to be traded in retirement accounts. We all know that. But there are a lot of issues that still have to be decided about that. Where is the bright line between education and advice? Yesterday, we did a quick poll of the retail firms, and at this point, they're all at a wait and see. They all were saying at least 90 days of reviewing a 1,300-page rule to see where they think they can come out in continuing to educate their customers in the use of our products.
Thank you. And I will comment on the DOL. A lot of firms in this room, in the exchanges, in OCC, worked very hard to make sure that options could continue to be used in IRA accounts without having the firm deemed to be a fiduciary. And I think it's an interesting commentary when our victory is things didn't get worse for the industry. And we have to be very mindful of that. And so I also want to amplify one of the points that Andy mentioned with respect to bank capital rules in the Basel III capital standards, in the risk-weighting assets. And so it's tempting to sit back and say, well, if I'm not a bank-owned clearing firm, that really doesn't impact me. I think we'd challenge that notion. We see a large concentration of market making clearing in several firms, all of whom are bank-owned, and are going to face and are facing increased capital requirements around that market making activity. And so we have to look and say, does the methodology of calculating the trade exposure make sense? SACR can bring some relief to that. The industry needs clarity on when SACR will be introduced to reduce those requirements. But we also have to be mindful, because we talked a lot about yesterday and over the previous day and a half about the challenges that market makers are facing. The availability of clearing could certainly be added to that list. To the extent that the clearing firms are going to have to hold increasing levels of capital, it's logical that they may scale back certain portions of that clearing activity. And then the spillover effect is they provide the liquidity. Where else is that liquidity going to come from? So I think it's a collective area of concern that we all need to be focused on, is the capital requirements necessary to support that. The other area that I think we've got a great deal of consensus on is increasing regulatory cost. We at OCC are obviously very mindful. Our mission is to be effective and efficient in providing the clearing and risk management services we do. The capital plan was a direct response to that. I don't think anybody would argue that the clearinghouse needs to be resilient, and having adequate working capital to ensure resiliency in a period of stress is something that's vitally important for all of us. So I think, from my perspective, dealing and addressing capital and the cost of regulation, I know when I think about the increase in cost, it's the control functions and the frontline business functions to add resiliency in our own organization. But with that said, we are also very focused on the effectiveness and efficiency of those services. And when we step back and look at the clearing fees in our markets relative to other markets, the clearing fees less than 2.5% to 3% of somebody's total implementation cost. We don't see that as a barrier to participation in the market, but we're obviously very mindful of that. I also think it's really important to continue to focus on the tax environment, because it's the economic incentive and use of the product, and whether the taxation is consistent with other forms of exposure, particularly around structured products, which can be an alternative form of exposure for many of our market participants. So with that framing of what we think the challenges for the industry are, Andy, what are we doing about it?
So I've got a couple themes to answer that question. One, we're working very hard to broaden the customer base and the adoption of our products. I think one of the good news items in the last couple of weeks was the Morningstar announcement of creating a new category for options for the first time. The override strategy is now an official category of Morningstar. I don't know if everybody got a chance to see Steve Sears' piece last week in his strike price column, but he referenced that this is a big move in the right direction for taking the options industry to Main Street. We see it that way. Our business development team has worked with the Morningstar team literally for the last several years on making and seeing that category happen, and we're excited to see that happen. And this is what we think is the first of many to come down the road. Another recent development, and something we worked very hard on with a firm called Wisdom Tree, was the launching of an ETF on our put right index. Again, it's a way for customers, in this case retail customers, to get into option strategies without necessarily having to have options suitability in their accounts. They can get the benefits of the risk-adjusted returns that come with a strategy with selling collateralized puts into the S&P through an ETF. And I think that is this is the type of thing we will continue to see going forward. Recent announcements, and again, work that came through our efforts, a lot of it happening at our risk management conferences. Our most recent one occurring in March, where we, for the first time ever, had a panel of institutional buy-side public pension funds. We had 5 people on stage, each talking about how they're using options in their portfolio. In the recent weeks, there's been 2 major announcements, one coming out of the Hawaii employee retirement system, the other one coming out of the South Carolina employee retirement system, where they allocated, in both cases, over $1.5 billion to options writing strategies. And I actually looked last night on my little red-blue map. Hawaii is a blue state, and South Carolina is a red state, so it looks like we actually have maybe crossed some political boundaries, and our product set is somewhat political agnostic. But these types of things with our business development efforts, working with both retail and institutional to better have them understand our products and to adopt usage of options and help them better get their positions or their views expressed through our product set is something I think that helps grow our products. CBOE has had 3 relatively recent announcements of either acquisitions or strategic partnerships in the technology space, all with the theme of providing customers or end users with the tools they need to better use our products. In order of those partnerships, the first one was a firm called TradeLegs. TradeLegs is a tool that is mostly targeted at pension and family offices, endowments, so institutional buy side who are not using our products. It's a way for them to, again, express their view into this technology and get in what is effectively an optimized position to take advantage of what their view is using our products. Our acquisition of Lowenthal last August, I think most of the room is familiar with the power of Lowenthal. Leading edge technology and the ability to take data and turn that into options strategy capabilities, very strong back testing capabilities. So a customer has the ability to again take a view, see how a strategy would do over different market conditions, and then have more confidence to trade in our products. The third one was a recent investment into a firm called Vest Financial, who was actually presented yesterday at the Financial Advisors Conference, which is another big part of growth for this business and one we all have to focus on. I think Eddie made reference to that. But Vest is creating new products and has a technology that, again, gives the customer the tools they need to understand how to best use our products. And in the case of Vest, the customer, up until the actual time of execution, doesn't even really realize that they're using options. They're just able to use the tool to get it to express what view they have, what their upside potential they're looking to get, what their downside risks are, and then turn that into a trade using our products. So I think these types of things are what we need to do to grow the product. It's education, it's providing new tools to the marketplace, and getting further adoption of our product set.
Thank you. Do you think the tools are necessary to deal with the increased complexity in our options markets?
I don't think they're. I think it's actually the opposite. I think they're demystifying.
Okay.
I think all 3 of what we're looking at, and many of what we do, is just trying to get people more comfortable with having them understand that there are ways to get into the market, get some protection associated with that exposure, and in many cases maybe capping the upside, but in return for having that downside protection. I think people are starting to understand that, and I think both the advisor space, the retail space, the institutional space are starting to adopt that type of thinking.
Shelly, where do you think we need to head?
Well, there's a number of areas. One of the areas has been very helpful, working with the STA Options Committee, trying to coordinate across the equity and the options markets. We are a derivatives market. We rely heavily on the equity markets, and coordinating the rulemaking, the regulatory front in the equity markets, it all has a direct impact in the options market, and we need to work very closely with the regulators on how changes impact the equity markets and flow through the derivatives markets. Another place that I think all the exchanges have done a really good job on with OCC's leadership are adding the risk controls, helping our members, both the order routers and the market makers, manage their pre-trade risk, provide tools to them so they can be more aggressive in the marketplace, especially the market makers. There's tremendous exposure out there. Again, talked about how the markets become so fragmented. I've felt a few barbs this week because we're going to be the next exchange. But what we're trying to do is bring our risk protections, our technology, our speed to the maker-taker space, another market segment where we don't currently provide service. I think those risk protections from all the exchanges and the OCC's leadership have been very helpful to the industry. the market makers need an incentive to provide liquidity. We are a quote-driven market. We're not an order-driven market outside of maybe the top 5 classes. And there's been so many headwinds for the market makers, which really are become the headwinds for the exchanges. Incentives to provide liquidity. There's been many market makers that have left the business. The perceived widening of quotes. Those are the headwinds the market makers face. And we need those market makers in the market. So anything we can do in terms of risk controls, controlling costs, will be beneficial to the entire industry.
Thank you. Just to go slightly off the topic, let's dive into Shelly's observations on risk controls. From your collective perspective, are OCC's risk controls too much, too little? Are we ready for them? Where do we stand? Kapil?
I think we probably have found a pretty good balance in terms of what role OCC should play in sort of enforcing exchanges to build risk controls. I know there was a lot of back and forth on is OCC taking probably another SRO role overseeing over exchanges, but without a coordinated effort, I think we all would be pretty much building these risk controls as we want them to be. So I really commend the effort that OCC has done in bringing all the exchanges and at least the 3 or 4 specific risk control areas that OCC has identified. So I don't think it's too much. It's an adequate balance. It still gives us an opportunity to compete by providing on top of building more risk controls on top of what OCC is asking. So we still have room to innovate, but what you are asking is the bare minimum pretty much that every exchange should have.
Yeah, I was going to give, I know not everybody agrees with that, so let's.
Who could that be? I'll jump in there because the risk controls themselves, Box is in full agreement. The risk controls are a great idea, and they are a great first stepping stone, but risk controls can never get we can never go too far, in my opinion, unless they become overtaxing. So that being said, risk controls are extremely important, and I can get into more about the risk controls. When it comes to the way it was, or the structure in which it was put in, we disagree with that, and we wrote a comment letter, and everyone's aware of that. And our reasoning there is that we don't feel that OCC should become a de facto regulator, where you'd said kind of an SRO role. I think it's more of a role like a regulator or like FINRA would be. Industry initiatives, they take a combined effort of all of us, which we're, of course, not allowed to do without explicit SEC control. And the SEC is the only one who is given that explicit ability in the 34 Act to, in fact, do those things or mandate those industry issues. OCC, at the end of the day, is a participant, and they're a monopoly participant in the industry. And when a monopoly participant can create what are, in fact, rules that are punitive if you don't abide by them, and benefit financially from that, we just don't see that as a great way to do it. In the risk control scenario, we don't really have a problem with it, to be quite honest. It's what's in the future. What's this setting the stage for? Are we entering are we getting onto a slippery slope here? We're very in disagreement with that. But going back into the whole idea behind risk controls, I think risk, while we talk, what are the solutions, and there's a lot of them, and the stuff Andy talked about with, providing your clients with a lot of other tools and information and data. These are the things that can get people to the education I spoke to earlier. Okay, we can educate people, we can give them tools, we can teach them a lot more, but at the end of the day, we need solid markets. We need real markets on our screens, and we need the risk ability, or the ability for these guys to control risk. Risk really comes in 3 places. It comes in operational risk, credit risk, and the market risk from the participants. So the credit risk is usually the biggest one, and that's where OCC plays a significant role. That's what really made options so successful in the early days. The problem we've got is that when something goes wrong at one of the clearing participants, we're speaking to the usage of capital, really 2 to 3 clearing participants control, or don't control, but are only the ones able to do or willing to clear market maker business. That's a scary thought right there. If one of these, if Basel III or anything else comes in that challenges the usage of capital, and let's just say Goldman Sachs says, we're not going to clear people anymore, it's not worth it, we've got a real problem on our hands. Suddenly we've got a single point clear. And maybe they would back out. They're both bank owned at the end of the day. So that's the kind of credit/operational side of it. And then we've got the market risk, which is what the market makers face every day when they're dealing with a fragmented marketplace and they're trying to put their quotes on the screen to make that displayed market healthy. They've got massive market risk out there. They're putting quotes out in 800,000 series, and if something goes wrong or somebody decides to sweep them with information, that'll be that's where the problems come into, and that's why they continue to widen out. The opportunity to put the quotes you're putting on the screen and the cost of doing that is not worth the opportunity for the amount you trade. At Box, we're focusing on that over the next 6 months, and we're doing a number of different things. As Kevin pointed out, is it auction? No, it's not just auction. This is a combined problem. And we're doing things like tying the allocation in our auction to our quotes. We're speeding up the way market makers enter and exit the marketplace so that they have it's much harder for them to get run over. Those are the things that I think are going to help our market to get much more robust, easier, and then there's all the other stuff on top of that: regulation, capital usage, everything else. So I'll stop there before I go too far.
I like the fact that you use OCC and monopoly in the same sentence. You're proving the point that I was making earlier.
Still no divs.
Well, let's go back, because I appreciate the opportunity, because obviously we respectfully disagree on the structure of our role. We think it's critical not to have erroneous trades get into clearing, and that we fundamentally have to guarantee the safety and soundness of that. We appreciate the perspective of future enhancements, but the risk controls are really designed for a purpose of protecting and enhancing the resiliency of the clearing, and we can debate and debate the merits, the approach to implementation, but we think it was critically important to take the step to ensure that. If we can go back, then one of the other challenges is we are a mandated central utility for options. We have an operating and capital plan that caps our operating margin. We operate with the utility mindset and orientation. We've returned to
we really don't want to discuss if you're not. Okay.
So, Ivan, get your perspective.
In terms of the solutions?
Yes.
Yeah. Yeah, so many of the market structure, items that we're talking about and headwinds are just larger than any one exchange group individually, and so they require thoughtful attention in the industry more broadly. And Shelly's reference into coordination and things of that nature are very important. And so that's where the review of pilot programs, industry advocacy through things like the Securities Markets Coalition and SIFMA, and then just the comment process and around the rule filings process is really quite important. And we've seen that play out quite well in terms of efforts around 871M and the fiduciary rule as well. I would echo everyone's comments around the risk controls. I think the industry focus on that and coordination has been a good thing ultimately in ensuring a safer and more prudent operating environment. In terms of the industry volume headwinds, that's an area where we collectively have to identify thoughtful ways to engage new and existing users. One way that we've done that recently is we launched a new product called the BIRDS, a binary return derivative security. And the thought process around that really is let's try and find new and interesting ways to engage people who historically have not used options as a mechanism for interacting in the marketplace, and provide a more simplistic, defined type of product that allows them to, as a foray into that place. The other side of it too is, can we use these products as a way of creating additional utility for end users ultimately? So I think we're trying to think about how do we engage new and existing users. It's through the new product angle and ultimately through efforts around education as well.
Thank you, Kevin.
So I just keep hearing all weekend on this panel, complexity, fragmentation, risk, and I think we're all paying the appropriate attention, whether it's the clearing firms or OCC, and we do support a baseline of risk settings that I think spur conversation and make us all pay attention to that. So I think that's good. I think that one of the points of risk that Eddie brought up, which is participant risk, I think we need to take a step back and say, where are we allocating our risk capital, our technology capital, and just took a look at some data recently. The bottom 1,000 issues that trade. So we're trading roughly in the industry 4,230 underlyings. The bottom 1,000, so from 3,200 to 4,200, trade a whopping 0.023% of the industry. So that's a lot of risk capital. That's a lot of resources. And maybe not every one is on 14 exchanges, but a bunch of them are. So just to do some short math for you, that comes out to roughly 4,000 contracts a day, which is 4 contracts a day in each of those symbols, divided by 14 is 0.28% or 0.28 of a contract. So I would like to spur some conversation with SIFMA, who's done a wonderful job in the SIFMA Options Committee over the last few years with obvious error, with some of the strike listing initiatives that we've talked about. And let's start a conversation of solving that. And I know, one of the default answers is usually, good, let's have a delisting policy. We've tried that. We've tried that for 20 years. And what happens is, well, you're left with strikes with open interest, and you talk about fragmentation or complexity. The last thing you want is, well, there's 18 lot in open interest in this symbol, so we're going to keep that month up. And this one actually still has a mini, which I think Nasdaq still has a few minis. So I don't want to do that, but I think we need to think differently and think about a way that, maybe those bottom 1,000 symbols, there's a lottery system of some sort where you go back and you just trade them on 1 or 2 exchanges with a very simple quoting obligation and rule set. And if it pops out by trading, who knows, 50 contracts a day, it's boom, it's multiply listed. I don't care if it trades 10 contracts a day, then it can be multiply listed. But we're wasting resources. And you talk about systemic risk, holy cow. I mean, if something bad does happen to some code at an exchange or OCC or at a participant, it could be awfully ugly. So I think that one of the benefits of, we're in a slow time, right? This is options industry. We're sitting here, we're all worried about growth, but the economy's not growing either. And I think I missed some of this, but I think Slade maybe referenced it yesterday. Kind of subject to GDP a little bit. And GDP, I think, for the last 5 years has not grown greater than 4%. When you look at 1995 to 2010, I believe it's 11 of 16 years that the GDP grew greater than 4%. So we are subject to the economy in some respects. Doesn't mean we put our head in the sand. It means you sit back, and that's when you do things like clean up the risk. So like a trader would do, it's slow, look at the risk in your position, and wind it down. We've been doing that as an industry for a long time now. So I think we're doing that. That's not a criticism. I think we just need to continue to focus on that and then also address these bottom 1,000. And honestly, the bottom 3,000 trade 2.37% of the industry. So I think we should take a hard, long look at that.
Would others agree with Kevin's perspective? Because I look at it, and part of it is we've doubled the number of strikes in the last 4 years. And then you start thinking and stepping back and looking at some individual names. On a weekly, I think the SPY has a strike range from 140 to 266, which seems pretty broad for a weekly product. Is there opportunities for us to collectively think about the strike intervals and the series that are being listed and address that?
I'll jump in.
Yeah.
Nobody else will, but there is, and we have tried it, as Kevin pointed out, for 20 years. The problem we run into is very much the same as the age-old question: how many exchanges is too many? You can't stop an exchange from doing it.
Yep.
And once one exchange, or we get together, there's an industry initiative that's put together to say, hey, let's start delisting them, let's RFQ them, let's do some other, some methodology. One exchange says, you know what, this I see it as an opportunity. Quite honestly, I completely agree with you. There's no value in those strikes at all. So I'm on that page. But it costs almost nothing for the exchange to list them. But you're absolutely right. The risk that they create is tremendous. And that's the problem, is that there's no methodology or way to stop that from happening. It almost has to be somewhat voluntarily or get pushed back from the regulators who, and Steve Lucarello brought it up, this is not their job. Their job isn't to address market risk. Their job is to address, are the SROs, in fact, creating markets that don't harm the customer and fit the 34 Act. That's their job, and it's as simple as that. And they generally don't take it much.
But we may have an opportunity, right, with SIFMA. They've taken an aggressive stance the last 4 or 5 years, and I say aggressive in a very constructive manner, in helping us sort of facilitate, well, we're not all getting together and colluding, but they can at least act as a steward for us to talk to the regulator and say, does this make sense? I'm not saying we'll solve it, but I think it's a conversation worth having. They've done great work the last 5, 6, 7 years.
Couldn't agree with you more. I think that's a good way to do it, and it wouldn't be a bad way to attack the problem.
Yeah, so I won't necessarily say I'm disagreeing with, but I think the other extreme here is there have been cases where, because of these rigid strike listing rules, we have missed the opportunity to trade in the industry collectively. When Google moved 60 points in a day, at the end of the day, we just threw our during the trading hours, we're just sitting, but we can't trade those strikes while the customer is asking to trade those strikes. So I think the answer is, I think they both are right. We need to do something about it. It's just the amount of data yesterday. I think Kevin Murphy painted a very good picture with those sheeps and whatnot. So I think we need to do something about it. Is it reducing the market maker coding obligation, not necessarily making them post code across all the strikes, or finding flexibility around delisting? So I don't have the answer, but we have to look at both.
Andy's got the answer.
I don't have the answer, but I do agree it's an issue. I think I agree with everything that's been heard. And one of the issues that I think we all face, though, is that price for success. So the next, whatever it is, ABC stock that does become that active stock, and one exchange or two exchanges percolate it and do the legwork to get it to the point where now all of a sudden everybody wants to trade it. That's an issue we're going to have to address. And
it's unaddressable.
Yeah.
Right. That's the problem.
Well, but I think Kevin's perspective is useful because he's talking about a trigger of whether it's 50 or 100 contracts a day. So it can stay single listed, but as soon as it breaks out, then make it available.
And I would add to Andy's point, though, when you have one of these low ABC Pharmaceuticals type stock, that's not legwork. You saw Henry's bubbles with all the market makers. I mean, there's so much overlap on every exchange. If CBOE has a single list on something that trades 2 contracts a day, it's going to be the same market makers. And if it trades, I'm telling you, if it trades 15 contracts a day, you could say, fine, it goes on all 14.
It's not, but the problem he's getting at is that, let's just say I've got some stock on my exchange and I'm the only one who lists it, and all of a sudden it blows up and immediately everyone lists it. Sure. That's great. There's only one problem. The routers don't have that much, they don't have the focus that we might, and they're not going to change where the primary route is. And suddenly that gets sticky.
So we'd have to talk to the routers about that and find out. That would be a valid point. Yep.
Well, it can be solutions, but there are problems that are very difficult to address.
And you're exactly right. The infrastructure and the routing firms tend to be a static table.
Exactly.
But Ed, I just want the conversation, right?
Yeah.
We might, who knows what we come up with, but let's at least talk about it with SIFMA. I don't want to do it without SIFMA. I want to do it, very transparent.
We're not doing it without SIFMA.
Yeah, exactly. We've all been there, right?
One of the
Shelly,
problem with that solution, I agree in principle, but if you have that many more stocks that are single listed, you have another single point of failure. One of the advantages we have in the multi-list market is we're de facto backing each other.
No, good point. That's why I said maybe even 1 or 2 or 3, just not 14 or 15 or 16 or 37.
But I think what would be encouraging is that the commitment to work together to find the solution, because I think collectively, we've been able to deploy technology and firms have deployed technology to deal with complexity, but we're reaching the point where it's getting harder and more expensive to deal with the level of complexity. And I think it's interesting and individually and collectively, the commitment to find solutions. And we have to be mindful of not restraining competition and innovation and letting people get the fruits of their labor, but recognizing for the good of the industry that there's certain opportunity sets. Shelly, you also had some other areas of potential collaboration.
I'm trying to remember what our conversation was. That was
okay. Well, we can come back to that.
2 days ago.
That was 2 days ago.
One other topic that was interesting yesterday is the discussion and perspective on auctions. And whether or not it's good or bad, I think, is less interesting. But is there things that can be done to improve them and what their role should be? And I think that would be a useful conversation in our time. Anybody have perspectives of the utility value of it, and then how we can work, or the exchanges can work to improve the utility value of the function?
Yeah, I'll go. I think in terms of the value of the auctions, they play a very important role. They add tremendous amount of value to the options industry. We heard it again yesterday. I think was it the blue team who was kind of in favor of auctions. The reason we still have a listed lit market is because of these auctions. In equities, you still have all these internalization procedures built in, but they all are going on the TRF. The exchanges don't even see that business. I think this is the beauty of options, and somebody said yesterday that the equity industry is feeling envy of option industry, the great job that we have done by bringing every customer flow, every customer order on the lit market. Without auctions, you don't have the opportunities for price improvement. You do not have opportunities for other liquidity providers to compete for that flow. So they do add a lot of value. Are there nuances? Are there side effects? Absolutely. You try to find one solution, it will have some side effects. Reg NMS is a great example. 10 years ago, it was designed to address a big problem of customer not getting the best price. But there are tons of side effects that have come out. We just continuously have to keep addressing it. So I think outright saying auctions are hurting the market, no, I don't agree with that. Can they be improved? Yes, there is always room to improve.
So when we first put our Pixel auction in years ago, we didn't want to do it. We don't like them. I don't think that they're good market structure by themselves, because not that in a limited case with moderation they're good, because they get price improvement. But we always worried that if they hit a critical inflection point, they could cause a problem. I think we're there. And I think if you sit back and just listen to the conversation, at Nasdaq, we're a little bit weary of talking about the auctions because we've been watching this since Pixel came out 7 years ago. But it really is at the point where everybody's interested. The red and blue team yesterday talking about them. They're constantly in the news. I think it's a competitive issue, but not one that I'm afraid to talk about because, we've put what I'd like to think of as one of the more intelligent auction mechanisms in on BX Prism. We've seen growth there, which is actually kind of nice. It does reward those who are on the markets. We have other things on the whiteboard that we'll be making changes to. And I think it's competitive in a good way, that the exchanges that figure out how to improve display liquidity with an intelligent auction will be rewarded. So I think that they're okay in moderation, but much like many things.
Not every auction is created equally either. Henry the other day cited one of the areas of growth in the business are complex orders. And for example, our complex order auction is a non-paired mechanism. It really replicates what happened on the trading floor for years and years, where a spread order comes into the market in between the resting bid, the natural legs of the spread, and gives the market makers an opportunity to step up and price improve from those markets. And I think that type of auction, clearly there are benefits to it. And I think those are the types of the paired auction mechanisms. I think we've exhausted the issues around those over this last couple of days. But I just wanted to point out that there are benefits to some of the auctions in the market.
Yeah, I think Andy brings up a good point. Sorry,
go ahead.
But the auctions they affect the market, absolutely, and they're a value to the market simply because they do provide a service. In many ways, what auctions have allowed is almost I don't want to call it a two-tiered market, but the ability for the retail client to get a favorable execution in some cases simply because it's less toxic flow that's entering the marketplace, and we all know that's what the market makers want to favor client or customers, but they can't put a separate quote up for customers and for market makers, so therefore the auction methodologies, that's what kind of brought them to the marketplace in the first place. If we say, well, wait a minute, they've gone too far, there's too many of them out there, how can we correct that? Let's stop having auctions started at NBBO and things like that. We've got a lot of other market structure problems that tie into it, including flash, including make-take fees, including payment for order flow fees. All those play a role in why and how auctions happen, and what Andy said, to the different types of auctions that are out there. So people say it's a problem. I would totally disagree that it's a problem. I think our total market structure can be improved upon dramatically, but saying we're going to stop auctions from happening or stop them in certain regards just doesn't make sense at all.
Yeah, I was going to say, no, I mean, it's difficult. I think oftentimes the two conversations are married between widening spreads and auctions, and I don't necessarily think that's always a prudent comparison. When you look at other factors in the market, a lot of us have referenced, the series increasing, number of exchanges increasing, finite level of capital spread out across a larger and larger number of strikes, et cetera. There are other areas that are also driving, quotes to be wider. That having been said, I mean, price improvement auctions are a useful tool at the end of the day to deliver price improvement in a number of circumstances. But like any new functionality that we introduce into the marketplace, we have to be cognizant of, okay, what are the intended consequences and what are the unintended consequences? And I think a number of us have started to reference that. And that's where you need to, like any tool, try and say, anything used in isolation ultimately is probably not a prudent thing, right? And so that's where we look at it and say, okay, well, how do you refine the auction and think about it differently? We require price improvement under 50 lots in order for, to kick off an auction on our exchanges. Should we be thinking about what is the minimum level of price improvement in order to kick off an auction? do we want to reevaluate market maker incentives, to Kevin's point around allocation? The other side of it, too, is fundamentally how are we measuring execution quality? If we're always looking at it as improvement over, the spread in isolation, that makes it much more difficult conversation. So how do we think about execution, quality more holistically, I would say?
Do you have a view on how to think about it more holistically, Henry?
The problem is that obviously execution quality is in the eye of the beholder, and so that's not something that you can answer in isolation, but it's certainly worth something thinking about more broadly.
Yep.
It's a structure. The auctions themselves have a structural problem. They provide a great advantage to the retail customer. We all agree on that. Price improvement's great for the retail customer. But it's another disincentive to quote. So much less of that retail volume is buying the offer and selling the bid. You find you have a situation where the market makers have a much higher probability of negative selection bias on their quotes, less of an incentive quote. They widen their quotes. But there's so many other factors that go into this. Auctions are getting blamed for it. But look at some of the other the other innovations that we've had in the industry over the last couple of years and the potential negative effect on the market makers. The weeklies have opened up another opportunity for aggressive, the wolves to pick them off. We have so many new news service, automated trading off of news services, and with the weeklies, we've such cheap gamma available, and it's so easy for people to take shots. And as a market maker, what do you do when you're trading an option with 2 days to expiration, and some news comes out, and that news service is automated, and they pick you off in the front weeklies? There's just so many other things going on in the marketplace that are causing the market makers to be wary about posting quotes, widening their markets, showing less size. It's how many strikes we have, how many months we list. It's not just the auctions. The auctions do provide a benefit for the retail customer.
Thank you. In our time remaining, one of the other things I want to think about is how seriously do we take the threat of the lookalike OTC products? Theoretically, Dodd-Frank was doing a lot to bring OTC products into centrally cleared and exchange trade environments and provide price transparency. Where do we think we are on that migration?
I don't know that we should be looking at them as a threat, but more of an opportunity, because they've always been out there, and they traded OTC before we traded listed. And I think that's our challenge, as to how do we bring those to the cleared market. And there's a couple of challenges there. We've talked about a number of them today. Uses of capital, the cost of clearing it, the cost of access to the marketplace, the notional value they can get access to. So those are all the challenges that are behind bringing OTC. And when we'll talk to some of those type of dealers, and I was actually on an OTC desk years ago at TD Bank, and I was shocked at the way they traded. And it was, I looked at every one of these trades and thought, oh my God, they could get such better pricing at exchanges. But then it was explained to me by the guys running the desk that, yeah, we could. There's only one problem. When I need to, get $100 million in notional for my, my customer who's running a huge annuity, I can't do it effectively. And then when I do, the exchange costs end up, between the exchange costs and the clearing costs, they end up running me over. And at the end of the day, they also like keeping those trades bilateral. So those are the challenges we've got to figure out how to solve. And all these regulatory issues that come up, or rather the regulatory overlay we're now getting, continues to push back the other way, and we're not allowed to go down that path. So, Shelly kind of brought it up earlier about all the exchanges back one another up. We've talked about the cost of regulation, Reg SCI, things like that. I think that's some of the areas that we need to have the regulators think about how the industry actually operates as a whole and start regulating as a whole, not so much at a minutiae level, because when they come after each and every one of us and every one of the SROs up here and say, the way that your backup generators run and where the water comes from to cool them, we need to know that, and we need a 5-block radius of any threats that could be around your data centers, it starts to get so encompassing, and at what point does it end? I mean, do these guys want to know at the end of the day, what river the water comes from, and can the grate be clogged by a kayaker swimming by it? It's insane how far they're going with this. And I think that our challenges for getting that business are going to be to fix these problems so we can get that business in.
So I agree with everything that Ed has said. In terms of the growth of the industry, what are the opportunities? Where do we go find the new customer base? There are still lots and lots of RIAs out there who are controlling 30 to 50 million assets under management. they're still very scared of the word options. Some of them don't even know what options are. There is an opportunity we hear in this day and age of robo-advisors and the new millennials who are not looking to trade some of the traditional products. I don't think they even want to know what call and put is. There is an opportunity for us on the product innovation side where we can create new, call it structured product for the lack of better words. And obviously the annuity providers are another segment. Some of these products, we've been talking to many of those product creators. Every day we explore these type of ideas. Some of these products are just not possible with the listed options market. Having OTC flexibility to be able to list some of these products on demand, whether it's the expiry, whether you're talking about European or Asians or different strikes, different expiry. There's definitely, that's probably the area where I think the new phase of the growth for the industry will come. We just have to think more innovatively about that.
I think I agree with you. I think increasing financial advisors' acumen here. Yesterday we had a financial advisor forum, particularly well attended. I think OIC is doing a great job to expand the education and outreach so that they've got more comfort with that product. And I also think you're right, though. It's also how we educate and target millennials, right? And I know within the OIC efforts, they've had a tradition of focus on seminars, but we're moving into the people who watch YouTube and want to watch a 90-second video. So taking the excellent content they have, making it more accessible in a video format, and allowing people to consume it on demand are things that we need to continue to invest in as the industry to make options more appealing. But I also think you're right. I don't think we want to talk about puts and calls with millennials. I think you want to talk about the outcome you want to achieve. So do I want to protect something? Do I want to generate more income? And so you're talking about outcomes rather than the strategies, and make it easier and more inviting for them to participate is certainly something that we in the retail firms need to continue to focus on to make sure that people understand the use and application. Because I also generally think we have to be concerned as an industry of, I think I saw a study, 65% of the U.S. population has a negative opinion of Wall Street, right? And we got to be cognizant of the investment cultures changing and people's perception of exchanges, liquidity providers, and banks. And we have to portray the value being created through the services we offer.
Yeah, but no one wants to lose money, and there is always a desire to grow that, the capital you have. Option is a great tool to provide those services. We just have to wrap it in a way that they understand it.
And much of the fintech in our business is replicating what the banks have been doing for years through structured products. And many of the structured products that are in the market are outcome-based products embedded with options, and probably in most cases the investor doesn't even realize that they have an option. So I think these new fintech offerings, I mentioned Vest, I won't run the commercial again, but these are the types of entities and that are coming into our business that I think is where we all need to be focused to help grow that pie.
Well, thank you. We have about 10 minutes left, and I've been asked to make sure that we left time for questions for our panel. So with that, we'll open it up for questions.
Joe, you're not allowed to ask questions. He needs a mic. Come on.
He's loud enough.
So one of the things, if you're going to think about...
He's going to get you a mic so people can hear.
If you're going to think about singly listing certain products for the sake of efficiency, promise us you won't charge us proprietary fees on them.
Okay. I mean, so if you think about what I said, and look, this is just really to start the conversation. Who knows where we end up? But we're talking about literally 4 contracts a day. You know, like again, divided by, so some exchange or 2 or 3.
More money.
We'll get So I would think if you did it, you would do it with a close quoting obligation. You would do it with, just a standard low fee. For gosh sakes, you could almost argue it should be free. These are not. I'm talking the bottom of the barrel.
And on the strike listing, rule, we worked with the exchanges for 2 years, and 3 separate times a proposal was put on the table that we agreed with. This looks great. It satisfies all the concerns we had. We think we should move forward with this, and it just always fell apart. And then at the end of the day, one of the exchanges withdrew from the whole process because the weekly rules were not OCC rules, and felt they couldn't discuss them because they were proprietary to each exchange. So, we're happy, and we know that we need at some point to get to a harmonized rule over strikes, and this is probably something that could be domiciled at OCC, but OCC is going to have to now change their rules to pull the weekly rules into it to get that done. That being said, your comments about auctions, we have been telling the SEC for years, why do you keep approving these opaque rules and forcing exchanges back to the table to develop another rule to compete with another exchange's auction process? And a big part of the problem is the SEC has made the retail firms so defensive about best execution in terms of being able to justify in a data-driven way that they're out there getting best execution, and they've made them so focused on EQ and have said to the retail firms, be careful what you ask for, because at the end of the day, as you make us all compete on EQ for your business, you're going to wind up with wider quotes, and it's where we are. And we've been telling the SEC this for years, and now all of a sudden they're like, well, wait a minute. Now they're so concerned about if they're having an adverse effect on market structure. So I guess my point is that with the SEC, I know that they feel like they can't dictate market structure because they only have to react to rule filings, and they expect us all to make comments on them, and based on those comments is sort of where they're going to come out. But I think we're at the point where either the act has to be changed or the SEC in some way has to change their approach to market structure rather than being sort of reactionary to rules, and be a little more proactive on, with input from the industry, what is really good for the overall business.
So, Joe, go ahead. I'm sorry. You make a great point. But I think one of the problems we encounter with the SEC and FINRA as well is a lack of practical understanding of how things work. They don't seem to step back and think about unintended consequences. They don't look at how you get to these points, you have to make a decision. We struggle with it as an exchange dealing with the SEC on rule filings. We at MIAX we're filing for Pearl, and we take a rule set to them, and they read through the rules, and they see these things are all new and novel. Well, they're not new and novel. All of us do these same things. Some of us don't have the detail in our rules. They don't understand enough how the business works. I was talking to somebody here this week. We were talking about the regulators at FINRA, and how somebody at FINRA bragged that we have X number of X floor traders on our staff. Great. What do they know about electronic market making? What do they know about electronic routing? The regulators don't understand enough about the unintended consequences of how things work. Yes, they look for comment letters. People comment when something's really bad. When something's in the middle, they don't get the comment letters. There's a lack of understanding from the regulators of how our business works, and it's taken us down a bad path.
I'll take a bit of the other side of that, and I agree with you in a lot of ways that there is a lack of understanding, but they're also challenged in a big way, right? The regulators are an organization that covers multiple asset classes. Steve Lucarello was talking about it yesterday. They are challenged in a lot of ways. More importantly is that we as an industry continue to challenge them, sometimes past their knowledge base, because in fact it's I don't want to call it a game, but what we're doing, and we've talked a lot about exchanges, how many are to exchange, we've talked about OCC. We haven't talked much about the participants' responsibility to the marketplace too. The reason there's so many exchanges is because the participants come to us and say, if you do this micro market structure change, I will give you more order flow. And that deteriorates the quality of the markets, but no one cares because they're going to make a little bit more money doing that, and the exchange lights it up and it works. So there's responsibility by everyone in the industry to make all these things work. It's not all on the exchanges. It's not all on the regulators. I think this is very much a combined effort, and the one issue we've got is we can't really work together. Neither can the firms. They can't get together and collude or do anything else. But certainly working together closer and starting to think about what each participant is asking for and will it long-term deteriorate market structure should be something people think about more often.
I mean, I just want to make sure that not lost in my comment. Auctions are a good thing. Customers have every right to try and get a better price in the marketplace.
Well, I appreciate that. I agree with you on that.
We're all saying the same thing, yeah.
Tony's definitely not allowed to ask questions.
Question for Ed.
So my question's sort of a broad question to anybody on the panel, but just wondering if the time's come in the sense that maybe it's time to consider a competitive alternative to a mandated central clearer for options, something, to compete. The products are fungible. Do we need a mandated central clearer?
Sounds like a Scott question.
Yeah, no, it's, competition is good, and it's hard to argue about competition. It goes back to capital, and what's the efficiency of capital. And so to the extent that you've got multiple clearers and you put clearing firms where they would have had a riskless position because they're long and short in one clearinghouse and the spread between the two actually exacerbates the challenges of capital. So I think we can think about competition there, but I think we actually have to think about the efficiency and effectiveness of the solution for the market participants. But ultimately, it's going to be driven by market participants' choice.
Yeah, and I will try to answer your question sort of on three angles. One is competition is good. It will keep the clearing fees down, as I was stating earlier. It will at least put some pressure on both sides to compete for and innovate the new products. The second is risk. Is there a single point of failure in the industry with OCC? Possibly, yes. Do we need redundancy? Yes. So that's another way to look at. There is definitely complexities, like Scott mentioned, in net margin across to interoperability between the two. And finally, to be honest with you, going back to my original point, I think OCC is now, and again, don't want to just preach to the choir here, but the capital structure that OCC is taking right now, it's becoming a funding source for half of us on the panel. It's just going in the wrong direction. So maybe that's a direction that is do we need another central clearing party here?
I think that you being OCC are in a very difficult position. You are owned by, pending this next merger, you'll be owned by three parents. Several of us on the stage don't have that ownership access. There's some amount of, you could call it paranoia, you can call it conspiracy theory. The reality is you're owned by a small group of the early exchanges. And I understand why it is the way it is. By not having the ability to have competition there, you open yourself up to situations, I think what Ed was referring to earlier, you're mandating risk controls. We're a big fan of the mandating risk controls. But how do you do it? By putting fees on exchanges that don't meet, it can be perceived that it's the big guys picking on the little guys. It's a very fine line. Personally, I'd love to see the ability to have competition. You offer a fine product. You guys do your job really well. But at the same time, I think we should open up the opportunity to have another clearing firm that allows fungibility.
I would point out it's probably less about shareholding and more about governance from my perspective of, do we have balanced representation on the board? Is there independence and objectivity? And are we balanced in the approach and focused on being stewards for the industry versus a commercial orientation to reward shareholders? And again, it's about being effective and efficient to provide those services and the capital efficiencies we're delivering to clearing firms. Because ultimately, I don't hear a lot of questions about CME or ICE's shareholders. And it's the value of the service they offer. So it shouldn't be about the shareholders. It should be about governance and being effective and efficient in the marketplace.
They have a vertical model. It's a different model than what we have.
Say, ICE and CME don't pass any money back.
Yeah, we do.
Yeah, but I'm saying they don't pass it back to single shareholders.
We rebate back to the industry as well, and we've capped the operating margin. So
agreed. We probably don't want to get into this discussion, to be quite honest.
Just going back to the last point, you mentioned balance. I mean, what will it stop tomorrow? Let's say NYSE and CBOE join hand. You have one owner with 60% of the ownership. Or on the other hand, if let's say tomorrow between MIAX, Ed, and myself, we gain majority of the market share, how could you have your board member with a minority in terms of participation in the industry? So
other alternative is you could buy one of the existing exchanges.
See how easy that is?
Yeah. Am I the only one that thought of LeBron, Chris Bosh, and Dwayne Wade when he said Eddie and Shelly and Kapil?
Frightening. Didn't know you were going to be taken to task here, did you, when you were signed up for this?
You know, on Friday the 13th, the morning slot, I knew I had angered the conference god someplace.
Moderator and panelist.
So can I just ask one more question before this panel ends? It's about ETFs. We've seen tremendous growth in the ETFs, both in the number of ETFs that have been listed as well as in the volume that's going into ETFs. And in fact, in some conversations that I have been having with some investment advisors, they look at ETFs as an asset class. Should we be all concerned that ETFs are becoming more of an investment vehicle, while individual stocks are becoming much more of an instrument for speculation or trading activity, where volume rises just ahead of earnings releases or management changes or product introductions, and we're entering into a bifurcated market where stocks are no longer as interesting as they once were?
Actually, I'll take a little piece of that. ETFs offer many structural advantages for investors. I get a balanced portfolio through a single exposure. You've seen the migration from mutual funds to ETFs. So options on that are no different than options on broad-based indices. So I think it's a healthy way for people to express broad-based view without single stock exposure. The area I might take exception with you, speculation versus trading, those are subjective opinions that everybody who owns equity is a speculator, right? Very few people are hedging. I don't think we should draw value judgments of the use of ETFs versus single name because they're used both for investments, they're used for risk mitigation. So I think that's somewhat of a false premise.
I agree. I don't know if it's the ETF that's the problem as much as you're absolutely right, though. The equities are being used more and more as a gambling tool in a lot of ways, and that came with the advent of everything from, call it the access through high frequency trading and everything else to the direction they've been taking. But at the same time, there still are a lot of value investors, and equities are still used heavily in large structured portfolios. So I don't know that I think it's a concern as part of the industry, and that's what creates some of that intraday volatility. But at the same time, I don't know that there's a whole lot you can do to try to quell that either. So Joe's wants to jump in.
You also see
we're going to end this pretty quick.
Actually, we're almost out of time.
I don't think so at all. Actually, what I think's happening is when people invest in ETFs, they invest in them, and they just hold them. Okay, so pre-ETF, if you're an investor and you wanted to buy Apple, you had a particular performance, target. Stock gets to 110, I sell it. I go buy something else. I trade something else. You're trading in and out of stocks. People are not investing in stocks. They're investing in the market. And that's why there's much less volume in individual stocks and so much concentration in the ETF.
Kind of David's point. People aren't investing in stocks anymore. They're investing in ETFs. But let's...
apologize and regret that we're out of time. I do want to thank my panel, Ed Boyle, Happy, Kevin Kennedy, Ivan Brown, Shelly Brown, and Andy Lowenthal. Thank you. It's been a pleasure spending time with you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.